Hello, everyone, and welcome to the Q&A for Environmental Trading Edge, Sleep Well Portfolio, Awake, and all of the other products that we have. We are just going to go through a little bit of macro first. That'll be the first thing that we go into, and then the next thing is maybe just a couple questions, and then I wanted to talk about the news cycle. First of all, Michelle, how you been? How's your trading been? Enjoying life?
Yep, I'm doing well. It's finally a beautiful day in Oregon. We get about 6 of those before July, so we're enjoying it.
That's so the truth. I mean, seriously, over here in Seattle, it's a beautiful day here too. It's like 65 and sunny, and we get these like peekaboos. That's what I call them in like April, May, a little bit in June. We still get these peekaboos, and then July, it's summer.
Yeah.
You know.
Yeah. We have a big Rose Festival parade and a whole week of events in Portland every year, and it's
Yeah.
always rainy through Rose Festival. And then as soon as Rose Festival is over, then summer weather feels like it's okay to start. So
Right. I basically always have told like all of my friends, anyone that comes up here and visits, is summer starts after 4th of July.
yeah.
That's the summer start. Whereas everywhere else in the world, I swear, well, not world, but everywhere else in the United States starts their summer at like what, May, June, earlier, right? Especially down in Texas. May is definitely summer, and then you just go into like August time frame, and it's just basically death, and it's a whole nother season of in itself.
Yeah.
All right. Anyway, so anything that just kind of stuck out in the forum or anything like that we just kind of need to hit up really quick before I get moving?
I think this week's been pretty smooth, actually. I think people are kind of getting into the groove of things. There's a lot
Okay.
fewer questions that I'm fielding anyway. So yeah, I think we're good.
Which is awesome. That means everyone's, lots of people are settling in. Even the newcomers are settling in a little bit faster, I've noticed. So either one of two things: either there's been a lot of things that have been answered in the forum, or it's that our setup process, and I think people are just realizing that the trades are just really easy to just manage and execute because a lot of it's done for you. So one thing that I will just touch base on just a second here is there was someone that reached out that has somehow not been making money using our intraday calendars strategy. And I was like, what? Because it's had a phenomenal time. Max risk is, so I say like max risk, but our level 4, basically using the highest allocations, is up like 250% for the year. Even the level 3 that we run, I think, is up 75 or something like that. So for the year, it's been really a fantastic time period, especially over the last few months. Last few weeks have been fine too. So, just kind of hearing that, it just kind of is like a red flag, like what's going on, right? Because I execute these live, Michelle executes these live. We do it in size. We know others in the community do it with a good size as well. So, and have great success. So digging into it further, come to find out, this person was taking losses earlier than what the trade parameters were saying. So they were cutting their losses a little bit early and not allowing the trade to breathe. That's a really important aspect. That's part of managing the trade and doing your due diligence on your side when you're executing a trade, to make sure you're following the system. The system is designed very specifically so that it can be executed and have positive expectancy. And anytime we change something, right, even though it might seem small, even though we might have some sort of rationale behind it of like, no, I think this market's just going to keep going today or whatever, like we have some sort of rationale behind it. We kind of kid ourselves into thinking that we're doing the right thing by changing the rules. And inevitably what ends up happening is exactly what's happening to this member, is that you don't make money. Also, there are other things that are happening as well, like not taking the trades every day, only taking them when he feels like it's the right day to do it, right? Those types of things can definitely make it because it's possible that the only days that you feel comfortable trading them are days that don't work out, right? There's some sort of back thing that can work out. Not saying that shouldn't happen statistically. If you just randomly pick a day, it should be fine. Just small things like that do change things, right? Entering in really late in the day, when we're already up money, when you exit out early. That was another thing that this person was doing as well. So, watch out for that, right? Let them get to their profit targets. As our environments change, so do our profit targets. That's part of our system. So, just if you run into that, whether you're trading our system, whether you're our systems, or whether you're trading someone else's systems, if you unless you know all of the variables that you're tweaking and whether it's an extra edge. So, let's say you want to take your profits early. You have to do your due diligence with the data to make sure that doing that is actually going to benefit you on those particular days. You want to quantify it before you do those types of decisions. Otherwise, we're just making irrational decisions, and those irrational decisions can end up costing us money and take a very successful trade that's up 250% for the year into losing 30%, which is practically mind-blowing when I first heard that. But come to find out, there's a lot of tweaks that have been happening to the system and not following it well at all. And so that's what happens. It's a very easy system to execute, and 98% of our users do fantastic. So it's just one of those things that if you start messing with things, it's not going to work out. So I just wanted to hit that up before we start digging into things, because I just want to be honest with all of you guys to make sure that, look, there are ways to ruin a good system, and there are ways to enjoy a good system, and sometimes that power is within our control if we're running something. So be like a machine, try to stick as close to the system as possible, and then if you have added edges, so you're kind of maybe a tinkerer, or you're kind of the engineer type, and you have some added edges that you want to overlay on top of that. Of course, use the data first, and then let us know, because that's awesome. We'd love to maybe incorporate those or do something really cool about that. So that's been nice about some of our members as well. All right. So I've given it a decent amount of time, and I've said that, and I don't see any new comments in here. So Michelle, you want to hear about some macro stuff?
Yeah, sure.
Yeah. All right. So really cool things. Okay. I dug into this a little bit into one of our Adapt Advanced meetings, and I think one of them on one of our previous Q&As. But I wanted to just kind of dive into this a little bit further. But first and foremost, I wanted to tackle my gosh, I'm having a brain fart right now. The Fed balance sheet. So the Fed balance sheet is still coming down. You can see that over at Fred. Here, I'll pull that up really quick, and I'll share my graph. You can always see that over at Fred, what their Fed balance sheet is. And let me get it. There we go. And share. Attack. Yep, there it is. So as you can see here, when we dig into the Fed's total assets, so this was the bank blowups back up here. So this was the couple banks that blew up. There was a little bit of a credit crunch, just a really minor one. I say minor, one of the 6 largest banks in the United States blew up, and some of the others. So it wasn't exactly minor. It also reversed 4 months worth of quantitative tightening from the Fed. But we are back on track, and the Fed is continuing to tighten their quantitative tightening. Now, if this kind of keeps happening and they kind of keep chopping up, even though the Fed is quote unquote tightening, they're actually not. What's happening is it's just going in waves that they're staying steady. So we can actually expect something more like what happened back here in 2015 if this kind of keeps happening, where they are bleeding assets off of their balance sheet, but at the same time, certain banks blow up or something like that, and then they pump some cash into the system again. So anytime that you see these assets blow up, anytime that the Fed gets assets on their balance sheet, that is printing money. So it's monetizing either debt, or it's just straight up financial asset inflation. Anytime we have financial asset inflation, it's bullish typically for stocks. So, we'll keep that kind of in mind back here. And the market is now finally just about rolling over at the same time that the Fed's balance sheet is continuing to pull back. Now, how much longer will that happen? We will find out. Let's dig into more macros. All right. So, do you remember, Michelle, when I talked about the relationship between the market back here and CPI and kind of like the Fed interest rate?
Vaguely. We also broke up a little bit at the beginning of that.
Okay.
What was it that you were talking about?
Do you remember when I kind of talked about what the relationship was like in recessions during with the stock market, CPI, and the Fed target rate? Those are like the three. It's like the magical three combo here, right?
Yeah, could run us
So
through it again.
it gets rather complicated. So the best, like one of the best examples of a deflationary recession is really 2008. You just can't get better really than 2008. So if we look at 2008, right, here's the buildup in the economic, bubble or balloon of the economy as things got better and the housing market heated up and everything. And eventually the Fed was like, whoa, there's some problems out there. So they stopped raising interest rates, right? And then it kind of ballooned up a little bit further. And then they were like, okay, this is ballooned up a decent amount, and we need to start cutting interest rates because it's starting to run too hot. It was creating too many bubbles, right? Very similar to 2021, if anyone remembers all that. So anyway, so they stop interest rates, right? But then what happens is inflation is a lagging basis, right? But they start cutting interest rates because they know that inflation is on a lagging basis. And what actually is happening is on month-over-month basis, which I don't have that right now. This is just the inflation in blue back here. There's deflation going on. So because this inflation metric is lagging, you can kind of shift this over just a little bit, and you can see that inflation is actually coming down pretty aggressively. And that's them reacting to that. So the bond market actually was pulling them down, and they were reacting to that. This happens in a deflationary recession. So assets normally go down very aggressively in a deflationary recession. It's normally a waterfall type of effect of risk off. The Fed normally cuts interest rates, so bonds are really fantastic to have during that type of deflationary spiral, deflationary death spiral. Here's .com, same effect, right? So it kind of gets up to the top here, very bubblicious, right? Fed stops raising interest rates. All of a sudden, CPI starts to dive bomb. The bond market starts to pull down. Here's our deflationary death spiral, right? Goes and goes and goes and goes. Well, one thing that I'm just gonna start out with here, in general, is what stops a deflationary death spiral or a deflationary recession? It's a rise in inflation, right? That's kind of how you know the end of the bear market is over, right? So, do I still have you here, Michelle?
Yep, I'm with you.
All right. So if we look at our .com, what did we have right here in the bottom? Right here in the bottom was the first time that we saw inflation start to kick back up again, right?
Mm-hmm.
All right. So I keep on going through. These are two deflationary recessions. Then let's look at COVID. COVID happened very fast, by the way. So this is like a superhuman fast deflationary death spiral, right? So here's the big blow up, right? The Fed stops interest rates, right? There's a deflationary death spiral coming, right? They kind of know that. They start dropping interest rates, right? This is the balloon that's starting to kind of happen going into pre-COVID. COVID happens, snap, deflationary death spiral out the wazoo, right? And then right here at the bottom, right, if you're looking at a month-over-month basis or probably a month-over-month basis is probably the best way, you can actually start to see inflation starting to kick in. And there's a lot of printing, and there's a lot of debt monetization, and there's a lot of checks being sent out to everyone, but it's creating that inflation. So what stops a deflationary death spiral is that inflation. All right. So what do we have on this recession? Is this recession a deflationary death spiral, right? Well, that's what's interesting, right? We have this inflation back here, right? And you have inflation cooling off now. You have the interest rates actually climbing, right? While the inflation's really high, right? So it's kind of like they're late to the game, is almost kind of the feeling. So the only time that that's ever happened in history, that's, that I can just point to very quickly, is going to be back here in the 70s and 75s. 70. Well, here we're gonna go with these two first. So this is 70. So first this rolls over, but this is important. The market's rising as inflation is rising, interest rates are rising, right? And then eventually this cracks, right? The market starts to crack. And then what eventually stops the meltdown? What stops it? It's the rollover in inflation. Completely opposite of a deflationary recession. So that's what I wanted to really kind of dig into right here. And I wanted people to realize what kind of recession we're in, right? So we have an inflationary recession while inflation remains high and stays high and the assets are rolling over. And then finally, when inflation cools off and the interest rates start coming down, assets will balloon again, right? Mm-hmm. Here we go again. Here's another one, 1974, right? Market's going up, right? High inflation as the market is actually coming down because interest rates are hurting financial assets. Boom, all the way down. And then what struck the bottom? The rollover in inflation. The rollover inflation is what let you know that we had a new bull market starting up, or at least a very large rally, right? And then what happened again as inflation started to rise again and interest rates started to rise again? Ouch, it goes again, right? And it goes all the way through this, all the way until we hit the 80s. And then eventually, right, we end up having the backside of this guy, which was the 1980 recession, right? This is where we were basically peaked out. Interest rates were through the moon, everything like that. But once this finally relaxed, we had this massive bull market that eventually ran all the way into 87. There's the 87 crash. That was kind of a freak phenomenon, balloon type of thing. But that happened because portfolio insurance. That was kind of funny. Anyways, I shouldn't say funny. 87 was atrocious, but I would, anyways, I digress. So, what was it?
It was interesting.
Yeah. It's just, like looking back at it, you're just like, I mean, it was a 25% in a day. That's not a joke, right? 30% correction in a matter of like 3 days. It's like, what? And of course we've got stops in there too. So it's kind of like our COVID. But anyways, all right. So going forward to today, where are we at today? Well, why was the market pulling back? The market was pulling back because of high inflation, right? We are in an inflationary recession. But then all of a sudden, inflation starts to roll over right around, we'd call it, June of last year? Till, June, September of last year, inflation was pretty solidly rolling over, right? Well, then, now it brings us into where we're at right now, right? But if history repeats itself to being like previous inflationary recessions, as the Fed slows down, rolls over, turns around, and inflation does come back to, let's call it 3.5 by the end of the year or so, which should be possible, maybe 4. Still above the Fed target, by the way, which means they're going to have to go back in. It's going to be a whole nother recession. But right now, that should be a little bit of reprieve. So we've got some slowing GDP that we're dealing with this quarter. We've talked about that for a long time. We knew it was coming. This is no news, right? It's all very common at this point. The portfolios have been adjusted for it. If you're in adapted advance, this is nothing new as well. It's just like this is normal, right? So the rollover, we might have a correction here that's somewhat decent, maybe, right? Because we've got these other macro pressures in line that are pushing up financial assets again. And that's the cooling of interest rates. That's the cooling of the tightening process. And now the rate of change wise, we're on the backside of that. So cool things to kind of talk about there, just to kind of get in line there. And then the last thing I wanted to talk about, Michelle, is the news. Have you ever listened to like CNBC or like financial radio or anything like that?
Well, I've listened to enough to know what you're talking about, but luckily it's never been a thing that I've followed or enjoyed. From sort of being out of the financial industry, I didn't join this till recently. Um,
Mm-hmm.
it's not something that I got too sucked into, no. But I do know what you're talking about.
Have you ever like have you ever paid attention to like what the market is doing while the news is talking about certain things without necessarily being too involved in the market?
Well, the thing that's been interesting to me is that even on a few of the platforms that we use and a few of the like just charting software we use, even that has, the market will go up or the market will go down, and then like a written in-house news article will explain why that just happened 10 minutes afterwards or whatever. So
Yeah.
even though I'm staying away from like the actual TV news, it
Hmm.
still pops up in the things that we use.
It does. You hear about these things, and what's interesting is those little pop-ins, I think, happen at very unique times. So I've been trading for a while now, professionally, and then of course personally, since I don't know, somewhere around 2010 or so. So I've gone through a couple things. There's been some COVID in there. There's been some contractions in December. I've studied 2008 pretty well. I was active in 2008, but I couldn't say that I was like professionally trading, right? I had investments. I dealt with investments and things like that in '08, but nothing too amazing. So, of course, I was around in .com, but that's a totally different story. I was a little young for that, so just kind of showing my age here a little bit. But going through these things, we can navigate them pretty well. But anyway, something that I've known just as someone that like comes in and just kind of throws some common sense at this. Like I'm just like, when I came in as like a novice trader at first, I thought that diving deep into the news was like, and like finding out what's going on in markets and like what's causing what was, I thought that's kind of how things ran, right? It's totally not, by the way, but let's kind of dig into what's going on, right? So I think first, Michelle, exactly what you said, which is the news is always backwards looking, trying to explain what happened, because that's what people want to know. Like, whoa, what was that, right? And as traders, that does us no good, right? Like if I could trade for what just happened a week ago, I'd be very, 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 I'd be partying with Jeff Bezos, basically.
Yeah, even if it's not correct. I mean, even if it is correct, it's still not even actionable, so it doesn't get you anywhere.
Right, exactly. Now, I mean, if you could sit there and go, okay, that's what happened, and then the next time that happens, this is would be my action plan for it, that would be a little bit of a different story. But you'd have to be able to see it before it happens. That's the point, right? So you'd have to be able to pay attention to the data, what's kind of going on, things like that. So like right now, what we are talking about in macros is something that you can see happening right now and you can plan for it, right? I'm not sitting here trying to time the market. I'm sitting there looking at historical recessions, knowing that there's two different types. There's deflationary and inflationary. Now that might be new news to a lot of people, but between those two, I know that this recession is not going to act like the recession of 2008, which means the bottoms are either already put in, or on this contraction will probably not go that much deeper than the previous bottom. So I think that we might have some sort of a decent correction right now, but it's probably not going to be very deep. So, and it might be close to over, in fact. So that might be like, what? And the reason why, there's funny things that go on with the news cycles. So this is the news cycle that I kind of see happen, right? So in bull markets, right? So let's just talk about a rally, right? So here's a nice big bull market. And if we zoom into this, let's just talk about this cycle right here. what typically happens is during this rally, you'll see these news articles saying something different than what you think, than what I actually thought they would be talking about. I thought they'd be talking about how good everything is, right? Because that kind of makes sense. Like, look at this. Look why it's so amazing. Look at this. They actually are not. Surprisingly, during the rally, they are talking about how bad everything is. That's just in general. Like, so if you start, so I started to Google like top financial headlines. You can start going to, oh my gosh, I'm losing it here. I actually have it saved, but Google. It's like a Google article or like a Google search terms. So you can look up Google search terms, right, and things like that. And you'll start to see how many articles are written on certain topics, and you kind of look and you can start scraping for positive and negative news articles. And a lot of positive articles or a lot of negative articles are actually being posted while the market is raging. And I thought that was interesting because that's not what I had thought. And that's that's during a bull market. Then the pattern that I've actually seen is that when the correction comes down, that sharp correction, everyone's been so dosed with bad news that when it finally rolls over, that's when they're like, yeah, see? And because they sold out back here or whatever, whatnot, and so forth. And then the panic sets in, but they've already sold. They already sold when the bad news was back here, right? And then they go, see, that's what happened. But that was actually just a buying opportunity, and they kind of set the panic, right? They set the stage first with all the bad crap. And then the hit, and then they talk about still the bad stuff that's happening. And then as it's rallying out of this backside, they're still talking about the bad shit, right? They're still talking about the bad shit. And then they have just a blip of good times, right? And then it goes through the whole cycle again, right? So something to note, like in bull markets, that what I've seen with the news cycle is a lot of the times there's good news, somewhat at the top, but there's been a lot of bad news while the rally's going, but there's kind of a mix at the top, but a lot of bad news a lot of the time, right? And then there's the crash, and then there's like the really bad news right there at the bottom. Whereas the bear markets are so different. It's so interesting. Actually, what's happening is down here at the lows, the panic is in. Full out, we're in a recession. This is why it's over. This is what's going on. This is definitely going down here. We've got targets down all the way down to freaking Timbuktu. It's all the way down here, all this stuff. Then during the rallies, right, they just dose this, what I call hopium. And it's like right there in these rallies, they're like, look at how strong the consumer is. Look at why this is that. Look at this data point. Look at that data point. This is why we're not in a bear market. Look at this. It's so amazing, right? And then all of a sudden, you've got all this good news. And this good news is actually flowing in as the market is actually starting to pull back, right? And we're starting to testing into lows. They're still dosing with these hopiums, right? And then the panic sets in, right? That's when the bad news articles start to hit. It's when things are like all the way now at new lows again. There's no more hopium left. Boom, this is all destruction again. And then the rally comes in, and then here comes the hopium, right? So it's kind of how it goes in bear markets. Now, what's interesting about the most recent news article, this is what I think is kind of interesting, the news cycle that I pay attention to, is there was a lot of bad news right here. A lot of bad news. And we were not into new lows. We were not dive bombing down. We were not pushing down into new lows when there was some really bad things happening. There were banks blowing up. There were financial institutions. This was going to be the collapse. This is like 2008. This is like this and that and this and that. And it's all sorts of bad stuff, right? That was all happening right here. But the market was not cracking under that pressure, right? Yet again, macros are stronger than the news cycle. But right now, all this bad news has actually been building right recently, right? They've been kind of setting the stage for this pullback for people to really kind of panic and not be in a buying mode, right? And don't get me wrong, We do have slowing growth year over year. We do have a contraction this quarter. I'm on that boat. But at the same time, this is finally, at least from the data that I look at, these are finally, all of this area right here is finally starting to be buying opportunities for the first time in quite a while, right? I wasn't necessarily buying back here. And I wasn't even buying back here. But now that this has kind of started to go, yes, we didn't make it up to new highs. So that's something to note on a technical basis. But we're pretty close to the end of this cycle of this recession. I do think that this is going to be a very short bull market. In fact, we might not actually make it all the way to the highs again during this bull market. It might just be a really slow, monotonous run. But that's kind of the way that these things roll. So it just depends on how aggressive the Fed is going to continue being and what the bond market does. So, anyways, I just wanted to kind of talk about the news article and or news cycle, and how sometimes the news cycle can lead us astray, and how the fact that it actually works differently in bull markets versus bear markets. And what I've been seeing is here at the top, there's been a lot of bad news, right? And it's been starting to kind of build up, and then this big panic kind of sets in. But when that panic or like those news articles get on like max tilt, that's when I'd sit there and say, hey, we're probably pretty close to being done, right? And it's because the market's just not collapsing underneath the pressure. So that's something to note. Price action versus the amount of negativity in the news. And running that like correlation and seeing if there's some sort of divergence is actually a really fun, quantitative measure if you wanted to dig into it. So anyways, fun things.
Yeah.
If anything else didn't come in. Oh yeah, what's up?
We got one question to finish up with. Do you expect the US dollar to continue falling?
Yeah, absolutely. Yeah, I definitely do. I mean, we're going to go through cycles. So wait, hold on. There is something to note that anytime that someone asks to make some sort of forecast or their trading system or something like that, because Michelle, you remember always talking to me about that when you first got into this, that it was important for you to know what time frame that person was talking about, right?
Yeah, 100%. Because you can be totally right on one time frame and totally wrong on a different time frame.
Right.
Yes, so critical.
So, yeah. So the second part of my question to you would be, well, what time frame do you care about? Right? Are you asking about next week? Are you asking about macroeconomically over the next year? Those types of things. Macroeconomically, we are slowing down our rate of tightening for our Fed interest rates, right? And our bond market is starting to give way. That typically leads to a weaker US dollar in the medium term, right? But then, so yeah, David. So in the medium term, going over this year, I would expect a weaker dollar when we get probably, especially when the Fed starts to ease, right? So yeah, most of the time over this next year, we're most likely going to see a little bit more of a weaker U.S. dollar. That's how it played out in the recessions in here. Let me pull this up. So let's pull up. We'll go to, what can we do? We can do. Let's do UP. UP won't go back that much, but DXY might. DXY. Let's go dollar index. How far back does the dollar index go? Can you? Yep, there we go. Thank you, Michelle. All right. So let's go back into, this is the dollar index, by the way, in these recessions, right? So this is what we're going to kind of dig into. What's the strength of the dollar? All right, and let's put on our handy dandy inflation, new price scale, and we're gonna do new price scale. All right, so here is our, oops, what did I put in here? Oh, I put in the same one. Hold on. Plus, and we want Fed funds, new price scale. Okay, so here we go. So let's kind of walk through this, and let's go through the 1974 recession, right? So here's inflation going up. Here is kind of the tightening cycle, and you can see how strong the dollar got through that tightening cycle, right? And that's very common. The dollar will get very strong through that tightening cycle, right? But then as the Fed kind of eases up, right, eases on the interest rates, right, as they start to peak out, you can see the dollar gets really, destroyed basically, and you can see all the way as the Fed interest rates really drop down. That's really what's going to drive the dollar, is how aggressive the Fed backs off of their interest rates. Most likely it will crush the dollar, right? But then as the rate of change of the Fed interest rates slow down, normally they're ahead of the rest of the world because of the reserve currency, it'll re-strengthen the dollar, right? Now, what happens sometimes is you get this backside here, which is where we have a worldwide inflation, and the worldwide inflation is higher than the United States inflation. And that was part of the reserve currency back then. It's not as strong right now because the reserve we're slightly losing the reserve status. So what ends up happening is if the rest of the world's inflation is higher than us, right, than the United States, as we hike, that's fine. But if they're hiking faster and more to try to compensate for their inflation being higher than ours, then the dollar will actually weaken on that. So it's something to keep in mind that relationship goes. So let's go to where we are now, right? All right. So where we are now is the inflation is coming down very aggressively, and the Fed is slowing down their hiking process, right? So yet again, we have the dollar pulling back and getting weaker. If that continues, which is very likely that the Fed will slow down their interest rates and eventually start cutting interest rates, we will most likely see a further degradation of the dollar with some chops. So I think this quarter we'll see a relatively strengthened U.S. dollar because growth is slowing and there might be a little bit of a cash grab going on as the Fed kind of finishes their interest rate hikes. But then on the backside, as bonds kind of collapse and everything kind of cools down relatively aggressively, I think you're going to see a pretty hardcore collapse in the dollar. So that's my guesstimate historically with macroeconomics. But yet again, Sleep Well portfolio and Awake will take care of that. But right now, they are definitely not any part of the dollar, and in fact, hasn't been a part of the dollar since way back up here. So, yep. And what else we got?
That's what we've got.
All right. The wall of worry. Yes, definitely there is walls of worries out there. Yeah, that's that whole old adage.
And Dave, I got your other question. I'm going to answer it in the forum for you from earlier. I think that's all we got.
All right, guys.
Else, email it to me, and we'll
for sure email us. Ask us questions anytime. You can always ask right here, and we'll see you guys next week.
Bye, guys.